Dividends are an important method of extracting profits from your company and should play a key part of your strategy of obtaining funds in the most tax efficient way. In this video, we will consider some of the issues that need to be considered in deciding the amount of dividends that you take. The amount of dividends that you declare is something that you should decide, not your accountant. If you simply just take money from your company in the belief that your accountant will make it right sometime after the company's year end when they do the accounts, you are missing out in two important ways. Firstly, if you don't understand how much dividend to take and the amount is simply determined on how much money you take out of the company, then you are not in control of your extraction strategy and as a consequence are likely to pay more tax needlessly. Furthermore, retrospective fixes by accountants are likely to be undefendable should they come under attack by HM Revenue and Customs. Dividends are transactions that involve certain legalities. These legalities will be covered in a later video. Needless to say, if these legalities are not observed, then the validity of the dividends can be questioned at a later date. Any dividends that you take are always taxed on top of all of your other income. How much you ought to take, therefore, depends upon how much other income you have. For the purpose of this video, we are assuming that you have no other income than the minimum that you take out as a salary. Please watch our earlier videos to decide how much this should be. If you've taken a salary that is less than your personal allowances, then you should always take a dividend to cover the unused part of these allowances. Any dividend that is covered by your personal allowances will be free of additional personal tax. In addition to this, you should also take dividends up to the amount of your dividend allowance, which is also tax-free. Once you take dividends over and above your available allowances, then these will be subject to the dividend tax. In the gap between your allowance and the top of the basic rate band, you will pay tax at a rate of 7.5%. In working out the top of your basic rate band, you should take the prevailing basic rate band itself and add to this the amount of your personal allowance. Dividends taken in this band, plus the amounts covered by your allowances, should be looked upon as a way of extracting profits at very cheap rates. If you don't take advantage of these alternatives in any tax year, then you lose the opportunity, as you cannot carry them forward and use them in a later year. You should therefore use these alternatives to their full, providing you have adequate profits in your company to cover them. Once you go above these amounts, then you pay more punitive rates of dividend tax. If you are a higher rate taxpayer, you will pay tax at an additional 32.5%. If you are an additional rate taxpayer, it increases to 38.1%. These tax rates should only be incurred as a matter of choice. That is, you choose to incur them as a result of a positive decision to take out dividends in excess of your basic rate band. This should not be as a result of an accountant's fix, simply to cover uncontrolled withdrawals from the company. Rather than incur dividend tax at the higher rates, it is better to consider other alternatives of extracting profits. These alternatives will be the subject of later videos. Dividends are a key part of an overall strategy of extracting profits from your company, and the amounts available to you at lower rates is subject to change each year. For this reason, you need to keep it under regular review. If you would like a free, no commitment meeting to discuss your situation, please give us a call on 01226 245824. we would be delighted to see you.